All right, well, good afternoon. Thank you for joining us today for Figuring Out FNHURS, Part 2, Making Your List and Checking It Twice. So, my name is Andrew Kent. I'm a shareholder here at Saltmarsh, Cleveland and Gunn, and I lead our post-acute and long-term care practice group. A couple of housekeeping items for today. As a reminder, today's presentation is being recorded. You'll receive a link to the recording within 24 to 48 hours. Your video feed and microphones are already muted and will be muted for the duration of the presentation to limit distractions. If you have questions, please feel free to put them in the chat. We will try to answer them as we can during the presentation or follow up after the presentation with answers. For today's presentation, you've got an outstanding team of speakers, including Allison Jones, Nicole Davidson, and Jennifer Zilakowski. Allison is a shareholder here at Saltmarsh, leads our external audit work for our healthcare clients. Nicole Davidson is a senior in our audit practice with a focus in healthcare. And Jennifer is one of the owners at Q3 Healthcare Consulting, and we're delighted to have her join us for the Figuring Out FNHURS presentation today. So you'll get to meet this team here in just a few minutes as we jump right into the materials. So we'll start off with today's agenda. So today's agenda is going to be a recap on Figuring Out FNHURS Part 1. The auditors are coming to town. That was our webinar from a couple weeks ago. Internal controls over financial reporting, balance sheet considerations for healthcare providers who are impacted by FNHURS, balance sheet considerations around liabilities and assets, revenue recognition and disclosures. So we're going to be going over all those topics today. As we jump into last week's, or more than last week, a couple weeks ago, our Figuring Out FNHURS Part 1, that webinar, we're not going to go into too deep on this today, but we went over what is FNHURS, the definition, scope, and compliance requirements, due dates, all that important information. We kind of figure if you're here today, you probably are familiar with what it is by now, but if not, obviously, FNHURS is the new financial reporting requirements for skilled nursing providers here in the state of Florida. They require audited financial statements to be filed annually. We talked about in that webinar the differences between FNHURS reporting and your cost reporting that most providers are aware of and are having to do on a regular basis. We talked a little bit about what an audit involves, what providers should be doing now to get ready, and what to expect as a first-time auditee. So all that information is available in that webinar. That webinar is recorded and available on YouTube. There is a link in the resources tab to click on that and go see it. So with that, we're going to jump right into internal controls for financial reporting for skilled nursing providers who are impacted by FNHURS. And I'm going to turn it over to Allison Jones. Allison.
All right, thanks, Andrew. We have a lot of ground to cover today, and we are really just scratching the surface on these topics, but this will hopefully give you a good start in getting ready for your audit if you haven't done one before, or even if you have, but it's been a while. So let's just jump in. Internal controls assessment is going to be one of the first things that your auditor is going to be looking at when starting to evaluate where the risks may lie within the audit. So when we think about internal controls, we're talking about more than just the policies and procedures that you have in place, although that's certainly part of it. But we're also talking about identifying the specific steps that are in place to prevent and detect errors and fraud in your major financial statement areas. Remember that significant financial reporting areas aren't limited to just the frequently used transaction accounts or the big balance sheet balances that you have, but it's also going to include areas with relatively smaller balances or less activity, but where big problems can happen if things are handled improperly, especially from a compliance perspective. So if you don't already have your internal controls documented for your major financial areas, that ball needs to get moving really as soon as possible. It takes a tremendous amount of time if you're starting from scratch, but hopefully you've already got a good solid set of policies and procedures you can use as a starting point. If you do already have a written control structure, you'll still need to review it, make sure that what's there is what's really happening in practice. And if not, either update what you're doing to comply with those controls or reevaluate whether the controls you have there need to be revised to respond to how the organization is evolving. So there are 5 components that go into developing a strong internal control structure, and all of these should be included in your written system documentation. First, the control environment. That's what you can think of as the attitude of the top leadership tier. Is going to include things like putting together a chain of command and communicating ethical standards, developing a code of conduct, those kind of things. For risk assessment, we could have a whole webinar on risk assessment by itself, but at its core, it involves not just identifying the risks that something could go wrong, but also the potential impact related to those risks and the mitigation strategies you can put in place to address those concerns. Control activities is the component that we probably think about the most. It includes all those day-to-day activities we do to prevent errors and fraud from happening in the first place, and also to detect problems before they really get out of hand. Information and communication, those are the channels you set up for communicating internal control related issues and for the documentation around how information is really captured and reported. And the control structure should be in a constant state of monitoring. We talked a minute ago about making sure what you're doing is what the control structure calls for, but the monitoring piece of the equation also calls for regular evaluations of the structure itself, and also what to do if control deficiencies are found. So those are the components you'll need to make sure you document. Jennifer, I think you probably have some thoughts on some of these.
Yeah, I have. Yeah, this is one that it could go for a long time, but I'll just say that, you know, most everyone should have documented policies and procedures, but I think what you said is really important, is to make sure that for critical areas that you also have a real step-by-step process document. And I usually found the best way to do that is to sit with different people. So I would sit with like the AR person and go, okay, show me step by step, what do you do? How do you get information in? Where does it go? Same thing with cash, same thing with AP. I think you have to just sit with those different people. And then while you're doing that, you should be checking to see, does that match what you have as a policy? And so where you find that you don't, then you need to evaluate, is it because they haven't been taught the right way, or because your policy had to be updated and it really didn't get updated? Because that happens a lot. Things change, a process might change, and then we don't go back and update our policies. So I think that's something that they can look at. Definitely when you look at risk assessment, you know, think about where things could be bad, like where things could go bad, you know, and particularly in nowadays, credit card fraud, identification theft is really big, phishing scams, so things like that. Those are things additionally that, you know, you may not were thinking about, but you definitely need to think about in our environment because it's rampant. And so, I mean, we see it every day, new organizations getting hit with any kind of malware or phishing scams. I personally had one time where I got an email from our owner who I reported to, and it said, hey, Jen, I need you to move this money to this account for whatever it was. And I knew enough to know that she would never ask me for that amount of money in an email, right? So I go to talk to her. I come back and my controller's at my desk and he's like, did you just send me an email asking me to move money? I'm like, no. And so he got the same thing. So it's, you know, you have to be very careful and you have to make sure your people know not to fall for those kind of things.
Yeah, I mean, and Jennifer, that's a great example too, because, you know, those scams are getting just more and more sophisticated. They'll actually know your accounts,
Yeah.
They'll know your people's names and everything. But, you know, Allison, Jennifer, Nicole, it strikes me that a lot of what we're talking about here, I mean, these are things that need to be done and need to be in place for audit purposes, but they're also just good general business practices, right? I mean,
Right.
that's where all this originated from, was just what are the best practices, right?
Right.
And so,
Right.
you know, if you're not doing some of these things, or you're getting ready for your first audit, you know, yes, there are going to be some work that needs to be done, but, you know, also you can look at it as a good exercise for your organization to go through and get this in writing.
Yeah, I agree, Andrew. It's definitely a good exercise. When you're talking about information and communication, you know, do you have an intranet? How do you post when you make changes to things? You know, do you have monthly meetings? Do you have monthly financial meetings, or do you have monthly AR meetings? What are the things, you know, the avenues that you have to communicate? Currently, I think everybody's doing CLAPI meetings. So CLAPI or compliance, do you have like a quarterly or monthly compliance meeting? These are all areas where these type of things should be talked about and discussed.
Yeah. And if you do have, like Allison, like if you have an area, even if you have policies, thinking about those recent changes. I know in our firm, you know, we've changed our online payment platform in the last couple of years. And so, you know, those type of changes can really drive, you know, drive control changes, right, Allison? Yeah, I mean, you can, you know, you now have a, you know, maybe all the checks used to come in paper, or somebody actually took them, but now you've got people paying online, or you've got people paying by credit card, and have you really looked at who has access to those systems? So
in a nursing home, we used to go in and we would see people's credit card numbers on stickies on the computer. You can't do that anymore. So, you know, those are things that definitely over time, to your point, things have become more electronic. So you have to have good controls around those systems.
excellent. Yeah. Allison, you ready for the next slide?
I'm ready.
All right.
All right. Segregation of duties. This is one of the real foundational concepts of internal controls. The basic premise here is that no single person should have control over an entire financial transaction process. For example, your person that's processing payments should be different from who's approving expenses. And on the revenue side, the people that are responsible for billing should be different from the ones who are collecting payments and tracking AR and following up on things there. So as you're going through and you're putting together and updating all your internal control documentation, segregation duties is going to be something you should address in each of the critical financial statement areas. So it's an imperfect science. It's always subject to cost benefit considerations, especially in smaller organizations that have limited staff. So when ideal segregation of duties isn't really feasible, you should make sure that there are some appropriate mitigating controls in place to help offset the risks there. That, you know, the same person or a couple of people can be involved in multiple phases of your transactions. So if, you know, someone outside of the transaction flow can come in and help conduct, you know, the regular reconciliations of the financial accounts and help to resolve some of the discrepancies, that could be a mitigating control. You could have a regular internal audit to test a sampling of transactions for compliance with the procedures that you put in place. You can provide training to your employees on the importance of internal controls and how what they do day to day, how that falls into mitigating the risks that are there. And, you know, these days you can even utilize technology tools to help set up alerts for transactions that are, you know, irregular or over a certain dollar threshold, those kinds of things.
Allison, would that be akin to, like, you know, I know we probably all seen it. You can have your credit card set up where you get alerts every time there's a transaction. So even if you're not a big enough organization, maybe you don't have a perfect delineation of duties and responsibilities, there's someone outside of the chain of approving the transaction who's getting constant feedback on what's occurring, something like that.
Exactly.
Yeah. Excellent.
Yeah, I would say, you know, this your little meme here is my favorite one, by the way, because Allison, this is from Santa Claus is Coming to Town, and that's the burger Meister burger, and his whole thing was no more toys. He stepped on a toy and he didn't like it, so he said no more toys. Nobody can have toys, and so he was like, I'm the only one that can do anything, right? Basically, he's the gatekeeper. And when you think about it, it's just not a practical or safe thing to do to have one person in charge of everything. You do have to have good control over it, but even in smaller organizations, so if you only have an office manager and you don't have anybody else, yes, they got to do a lot, but there should be maybe a spending limit put in, or maybe 2 signing of checks so that that person can't really send out a check without someone else checking what it is that check is going to and looking at the documentation or backup to it. So there are ways to do it without having to try to like take everything away or funnel everything to one person all the time. That doesn't, solve the problem.
Right.
Yeah,
Exactly.
no, great comments. And I like the fact that you know this reference.
I do. That's my favorite.
I think we're all at that age, well, except for Nicole, that we know this reference.
Right.
Ready for the next slide, Allison?
Oh, not quite.
Okay.
Just did want to point out that most of the operational controls that you're going to have within the organization, they're going to be tied directly to your financial reporting. Things like your charge capture process, reviewing your medical records for accuracy, and coding compliance, regulatory compliance. I mean, we could go on and on about that. But there's the granddaddy of them all that we've been talking about a little bit already, is the IT controls. Really have an impact on everything we do these days. So I think the need for tight controls here is not surprising to anybody. There's a huge focus on cybersecurity threats right now, as there should be. But I did want to point out that the focus on cyber shouldn't be to the detriment of some of the other important IT control areas. So don't forget about access controls. That's documenting how you grant and remove access to your systems and to your software, making sure that only authorized personnel can access your financial information, making sure that other security measures are in place, your encryption, your firewalls, your passwords, updates to all your security protocols and things. And then disaster recovery, no matter where you are, is important, but here in hurricane country, it's not a matter of if, but when we're going to be dealing with a disaster. So making sure that your regular backups are done, everybody knows how they're done and how to restore them, other plans to deal with data loss or system failures or kind of whatever gets thrown your way. Your auditors will want to know how you've addressed all these things and how you are ready to deal with trouble when it pops up.
And I'll have to say, from my perspective, this is always the most difficult piece because I think IT people aren't always wanting to be forthcoming about how they do things. But I can say from practical experience, this is the one place that you definitely need to make sure that these things are in place, because it's too late to do it when something happens. In an organization I was with, we had someone who got an email and it said, click this link, and it was it says it was like a fax or something. So they clicked the link, even though the person where it was coming from was not someone we knew. It then started this whole malware program that basically locked all of our different drives, right? And so that could have been catastrophic had we not had a good data backup recovery system. So at most, I think we lost like a day and a half of work, where we were able to go back to that day and a half where we had that backup and pull everything up. And so that's really not, that traumatic, but it could have been, because if we didn't have that and you are now locked out, you either have to pay ransom or you have to start over, and it could be catastrophic. So these are things you can't wait till it happens to find out what you're going to do to it, because if it's too late. So it's definitely something to think about ahead of time.
Yeah, these are all great comments, and I mean, I think everybody on this call and probably everybody out there watching knows that of providers who have been hit by these sorts of things. I'll just point out that, there's been a huge push in Florida for disaster preparedness with regards to patient care and making sure your building's ready. This is kind of a different component of that conversation. So, everybody knows about the generator requirements and, cooling requirements and everything else. Maybe this may be something that has may or may not have been overlooked in your organization. So just be thinking about those things. All right, excellent. Anything else? Allison, you ready now?
I'm ready.
All right, now we're ready. We'll move on then to the next slide. If it will go, there we go.
Okay, we'll be moving away from internal controls, shifting to some specific financial statement areas and considerations there. But I wanted to just remind you, that the definition of financial statements in the new FNHURS rule actually points to a separate rule in the Florida Administrative Code for that definition. And that rule says that the financials are to be prepared in accordance with US GAAP. So the remainder of our time today will be focused on what we expect may be differences you'll be dealing with if you're having to convert from non-GAAP or not quite GAAP, if you're on something like an income tax basis, to GAAP basis financials. So as a reminder, if you're not already being audited, the rule does allow you to submit your first year report with unaudited financials, but then the next year you do need to include a 2-year audit report. So for a December 31st, 2023 year end, your report that's going to be due on April 30, 24 can have unaudited financials, but then the report due April 30, 25 will need to include audits for both fiscal year 23 and 24. And similar with your June 30 year ends that are going to be due on Halloween. Lovely Halloween gift for those folks. All right, I am going to kick it to Nicole. She is going to go over some of the balance sheet considerations for some assets that we think may require some attention from you guys if you need to convert to GAAP basis.
All right, thank you, Allison. So there are several balance sheet areas that we wanted to touch on that either have special significance in the healthcare arena or are areas where there are likely to be differences to deal with if the books aren't already on the GAAP basis of accounting. First off, we have patient care receivables, and this is a critical financial statement area. We'll delve into measurement and timing of recording receivables when we take a look at revenue recognition in a few minutes. But how you track and book receivables and contractuals and how you assess and record bad debt is going to be different in GAAP versus non-GAAP financials. Next, we have capital assets, and these are going to be comprised of all your property, leasehold equipment, and etc. Under GAAP, this is recorded at cost, but the threshold used to determine what gets capitalized and what gets expensed is going to vary company to company. And it's super important here to have a formal, approved, and monitored capitalization policy to mitigate the risk that earnings may be manipulated by having either too much or too few costs running through expenses. And Jennifer, I don't know if you have anything you want to add here on capitalization.
I do. Thanks, Nicole. So I would just like to say that, even within the company, you may have different ones because there are certain requirements for Medicare and Medicaid that are different than the IRS numbers. So in my case, what we've always tried to do was we tried to pick the most restrictive one and then know that you really have separate behind the scenes account limits for other things. So for example, Medicaid is 500. So our policy was 500 because that's the one that most everyone then could follow. But we also kept track of the different one, that same asset at different levels based on whatever we were doing, whether it was for Medicaid, if it was for Medicare, because they're all different actual limits. So I think within an organization, you may have different ones. Is what I think gonna just point out.
Great points, Jennifer. So it's also super important to consider that if you're switching to GAAP, usually you're going to use the straight line depreciation method, which is going to be a switch from what we're used to seeing under the IRS permitted tax basis asset lives. And useful lives of the asset may also be different under GAAP guidelines, depending on the type of asset. This measurement difference in tax basis versus GAAP basis depreciation is usually quite large and can affect capital assets and equity as of the beginning of the year that it's going to be converted to GAAP. So here we're seeing a switch from accelerated depreciation methods for booking depreciation to straight line. Next, we have deferred taxes, and this is a significant area that's going to come into play for non-GAAP to GAAP conversion for providers only if they are legally structured as C Corps. S Corps, partnerships, and LLCs will not have to worry about this area. However, C Corps will recognize a deferred tax asset or deferred tax liability based on the types and amounts of differences that they have on their GAAP basis books versus their tax basis tax returns. Some of the bigger differences are typically from variations in depreciation expense and the amortization of goodwill.
Excellent. Any other comments? Or Nicole, are you ready for next slide?
Go ahead and give me the next, Andrew. Okay, so it's somewhat rare to see providers who still have inventory balances for supplies, meds, or other items. But if you do have inventory and it's significant to your financial statements, us as auditors will need to perform test counts of the items included in the year-end balances on or very shortly after the time of the internal year inventory count. Recent changes in GAAP standards for lease accounting have also resulted in huge impacts in the financial statements of lessees. Under the new lease standards, each individual lease agreement must be analyzed to determine the pertinent provisions that feed into the data and assumptions used to calculate what it has been termed of a right of use asset under a lease. All of the relevant data extracted from the lease agreements is used to calculate the net present value of future lease payments that will be recorded as a right of use asset and related lease liabilities. And this is something new that we've seen a big change in our providers' balance sheets, especially if you have a large amount of leases.
Nicole, are you talking about all kinds of leases or just real property leases here?
So this is going to be your operating and capital leases. And it's going to vary between the two depending.
It'll be all kinds of things. It's not just your buildings. I mean, you could have
Copiers.
Yeah, office equipment, large office equipment.
Yeah.
Vehicles, anything like that.
No, that's
I've
just
also seen some significant telephone leases. So really anything needs to be evaluated just to be sure that your balance sheet is up to standards.
And this is a spot where we look at materiality too. Your water cooler lease is probably not going to be material, but we need to know that there's a lease out there and that somebody's looked at it to see if it's material.
excellent.
Great point. Goodwill derived from past business acquisitions is going to be amortized differently for tax purposes versus GAAP purposes as well. And not only is amortization different, but GAAP is also going to require that goodwill be assessed for impairment when certain conditions are present. If goodwill is determined to be impaired, an impairment loss is going to need to be recognized.
Excellent.
All right, I'm going to hand it back to Allison, who's going to touch on some liabilities.
Okay, thanks, Nicole.
Yes. All right, so there are some liabilities that aren't unique to SNFs or to really healthcare in general, but that still need to be looked at regardless, to make sure that balances are still being presented in accordance with GAAP. So some of this is accounting 101, but we'll go through it just as a refresher. So if you're currently recording expenses on a cash basis or income tax basis, if you aren't paying close attention to the periods when your expenses are incurred, when you're booking your AP, you'll need to start doing that so that we can ensure that the cutoff is correct, since expenses should always be recorded in the period when goods are received or vendor services are provided to you. So similar with payroll and PTO, any pay that's earned during a period should be accrued during that period. That means that last payroll of the fiscal year that may cross, over from December 31, through the first couple of days in January, you'll need to split out the pay and come up with some estimates to be able to determine, okay, what really belongs to the fiscal year we just finished versus the new one that we just started, and make those journal entries to get that right. So Nicole,
and Allison, I would just add in that if you haven't done this before, a big thing, an important part would be to come up with like a month-end close calendar and start trying to put on there where things are. So if you know that payroll ended on Friday the 27th, but you really have to go till the 31st, what you're going to have to accrue those days that are after that last pay period, right? You also can have, maybe you give until like the second business day for people to get all their, payables in, because whatever doesn't get in your system as of the like 12/31 year end or whatever month end date is then going to have to be accrued. And so that becomes a huge, big thing too. So it's sometimes better to come up with, okay, on the second business day, so that way people know they have time to get things in. And same thing with AR, like how are you going to do that? So I think it's important to come up with that kind of month end process so that you can be consistent, and then that's going to help you obviously going forward.
Right. Okay. Nicole talked a little bit about the new right of use assets that are now required under the leasing guidance. So you will have also some corresponding lease liabilities that are going to be part of those journal entries to record lease assets. And while not incredibly common, it's worth mentioning that there are some deferred comp arrangements out there that may need actuarial involvement to get certain factors estimated that may go into deferred comp liability calculations. So if you think you may have one of those types of agreements, it's smart to be talking with someone, hopefully your auditor or folks within your financial leadership, to see, okay, do we need to get in contact with an actuary to get some help here.
Excellent. Next slide, Allison.
Please.
All right.
Okay, there are also some liabilities that come up under GAAP reporting that you don't ordinarily see unless you have a settlement that you're about to pay out pretty imminently. But estimating these liabilities under GAAP can require some pretty specialized knowledge and expertise, and may again involve getting an actuary on your team to help. So for med mal, depending on how your policy is structured, the claims liability under those policies can get really complicated if there's any level of risk of loss that you guys retain. Similar with workers' comp insurance, there may be a liability that you'll need to record for incurred but not reported claims if you have a self-insurance component within those policies. Those estimates can get, again, very complicated and do involve getting an actuary to help you there. And unfortunately, here in Florida, we deal with more than our fair share of lawsuits. So you may have other legal liabilities and litigation that are unrelated to med mal claims and things that you'll want to work alongside your attorney with to determine, okay, how likely are these is there going to be, a material settlement for these cases? Do we really not have a good idea yet? The goal of that conversation, that assessment, is to really determine, okay, which cases have liabilities that require recognition in their GAAP and which require disclosure only and don't require an entry, at least not yet.
Yeah, and I know we're seeing more and more providers using self-insurance vehicles and that sort of thing to manage their liability insurance costs. So if you are self-insured or just keep in mind that there may be some complexities, right, with if you have not been audited.
And if you're not self-insured and you have a policy, you still might have some issues because a lot of the policies are large deductible policies. So if you're responsible for the first $500,000 in claims, you almost are basically self-insured, even though it's not technically a self-insured policy. So I think there are some ramifications for some people, even if you think, oh, well, I have a policy, I'm fine. So you definitely need to look at this, particularly with your attorneys and with your accounting firms to make sure you understand where do you sit in that, bucket of what has to be done, because I definitely think that there's a lot of people that get policies, but they're basically self-insured, even though they're technically not.
Right. No, great point. All right. Next slide, Allison.
Sure. Who wants to talk about revenue recognition? Let's do it. Okay, so there was this massive overhaul in GAAP accounting guidance for RevRec that went into effect fairly recently, about 3 or 4 years ago, for private companies and nonprofits. So the concepts in that guidance were drastically different from what we had been doing, and it ended up affecting some industries more than others. But the RevRec process in healthcare, was already complicated enough, with the coding complexity and various payer sources and reimbursement models and everything. So now on top of all that, GAAP requires that each customer contract, which for healthcare is either the implied patient agreement or an actual written agreement. Each one of those patient agreements is supposed to go through this multi-step process to ensure that the proper amount of revenue is recognized at the proper time under that new standard. So the good news is that patient agreements with similar characteristics, they can be analyzed using what they call a portfolio approach as a practical expedient. So for SNFs, this means that patients under a particular payer contract, they can be assessed together in a clump. And similar, self-pay patients, they can be assessed in a clump altogether. So you're able to segment some of these types of contracts to aid in this whole process. So these steps that are shown here are vastly oversimplified, but the basic idea is that the new RevRec assessment itself is this 5-step process. So we start with documenting information about all the types of payment or patient contracts and payer sources that are there for each significant revenue stream that you have. So that's, not just room and board therapies, but I mean, that could be beauty shop, really any of the revenue sources that you have. So once you identify the types of contracts, you'll have to look at them and say, okay, what are the performance obligations? What is required for the provider to do under this agreement? So this is going to include, individual services, bundles of services, providing goods, if you do that at all, really any number of things. So then the transaction price is determined under the pricing model used for each of your revenue streams. And there's this concept of fixed versus variable components of the transaction price to consider. In a retail environment, variable components are going to be things like discounts and returns and even loyalty points that you get. But in healthcare, your biggest variable component is going to be your contractual allowances. And then there are a host of other pieces that are going to be also significant, your performance-based incentives, and then also what they're calling adjustments for unreimbursed costs. So that is what we all used to call bad debt expense. The standards require that bad debt expense be estimated in this step when we're determining the transaction price. So that's even before the revenue is recognized, which is different from how we're used to estimating an allowance for uncollectibles, under old GAAP. So once the transaction price is determined, it then has to be allocated against all the performance obligations that are up there in step 2. And based on how and when those obligations are fulfilled, the timing of actually recognizing the revenue is determined to be either at a point in time, so essentially all at once in one clump, or over time, which is sort of like in installments. So that's going to be all dependent on how you, the results of the previous steps that you go through in this process. So that's a very, sorry.
Oh, I was just going to say, this strikes me as one of those areas where it's really important to be working with somebody that understands healthcare and skilled nursing in particular, because the things you're going through are things that all providers in the skilled nursing arena are going to have to deal with. And if you're having to teach your auditor, who your different payers are, and that's just going to make life a lot more complex, isn't it?
Right. And this is a very, very high level explanation of an accounting standard that was so intensely complex that, you know, all our standard setters, they gave companies years to implement it. And even then they deferred implementation date a couple of times. So definitely an area you want to start working on very, very early on, well ahead of your actual audit.
Very good. Any other comments or around revenue rec? Big issue.
A lot of fun.
Yeah, a lot. I can tell. Something you enjoy. So that's all right. Disclosures then.
Yeah. I won't be getting into a lot of detail here, and this is not in any ways an all-inclusive list or anything, but I wanted to give you an idea of some of the note disclosures for the financials that may take some time for you to put together. So the language and the structure for these notes, that can be drafted anytime. You don't need to wait until the audit's in process. You can be working on this, you know, as soon as you can. So in the area of AR and RevRec, you're going to include all your RevRec policies here and information about that, your payer source mix, information about your contractuals, kind of anything that goes into that 5-step process of revenue recognition gets summarized into your financial statement notes. And then if you do happen to be structured as a C Corp, you'll need to disclose all the items that are included in the calculation of your net deferred tax asset or liability that you have on the books. Include information about your carry forwards that you may have and any valuation allowances that you may have estimated if you think you could potentially not end up realizing some of your deferred tax assets. That needs to be disclosed. Leases have a bunch of new disclosure requirements under the new standard. We've always included lease agreement details. That's not new, but then information and some of the assumptions, like the discount rate that's used for the calcs of the right of use assets and lease liabilities, all that needs to get disclosed. And there's also a schedule of the future minimum lease payments that will be included as well.
So Allison and Nicole, for our viewers that may be like really fresh and new to the audit world, may not even ever seen a formal audit report, where do the disclosures fit in to that audit report and the audit opinion? I mean, where is all this going to come out?
Sure. So the financial statement package, just kind of rolling it back a little bit, that will include not just the audit report that we issue, but that's going to include your balance sheet, your profit and loss, your cash flow statement, any supporting schedules, if you have consolidating schedules, that kind of thing. And then there are the note disclosures. You're going to have pages and pages of policy notes and information about the details within some of your balance sheet line items. It's going to get into all of these different areas that GAAP says thou shalt disclose. So where we typically start with that is with an entity that's similar to you. You can find a lot of public company information, you know, from SEC and such online that you can get an example or some of the ideas for how you want that language drafted. That's always a kind of a good starting point. And then your auditors will come in and say, okay, do these notes that you've drafted, do they have all the required components? Is the language appropriate for the how your organization operates? So there's a significant amount of back and forth, especially in the first year as you're getting all these disclosures together.
Once again, having a firm that's conversant in the healthcare space and long-term care in general is important here, right?
Right, and we kind of have cheat sheets for clients too. You know, some suggested disclosures that we can.
And Allison, Allison, if you're talking about a multi-facilities, if you're not just a standalone, wouldn't that also go to like how do they allocate, you know, any kind of expenses or anything across their portfolio? So do they use beds, days, patient count, employee count? Like, shouldn't they have that sort of documented of like, how do they decide how they've been allocating out those resources to all the different entities?
Yes, absolutely. I mean, that'll be a major item that we'd be looking at in the audit. And yes, there should be some information about that in the note disclosures as well.
And I think shouldn't they also, like, if they've made any major changes, in a process, in a big vendor, you know, their main software, if they switched it out this year, some, you know, things like that, like any kind of significant event kind of things, they would probably need to think about those to make sure that they're reviewing those with you and that they're properly disclosed.
Exactly.
Excellent.
Okay. We have a couple more slides on disclosure, so.
Yeah, next slide.
Okay. Oh, we already talked a little bit about all the contingent liabilities that are particular to healthcare. Information about your med mal claims liabilities will go into the notes. Any of the other legal liabilities, there are disclosures required there, whether or not you've accrued any amounts for potential settlements on your open cases. And you'll need to include some details about your employee benefit plans, including, you know, significant plan provisions, if you've had any changes to those provisions, and amounts that you've contributed to those plans during the year.
Excellent. Next slide.
Please. You'll also be including information, about your risk management approach and the different types of insurance coverage that you have, any transactions and balances that you have with related parties, you know, affiliated entities. The details of those transactions get disclosed. And as Jennifer said, you have any other significant events that go on, which can include any number of things, right?
Yeah, and I was going to mention too, even on that, I mean, it can be operational events. So if they have a bad survey, if you're getting an IJ and you're going to get any kind of ban on admission, or you're going to, you know, anything that would significantly hurt the operation part, that is also something, even though it's not technically, it's not in the financial accounting books yet, it's something that's going to happen. It definitely needs to be brought up.
Right. And that goes for some events that happen after year end, not just, you know, during the year that's being audited. You're exactly right, Jennifer. Some of those things you don't see the financial impact of yet, but they are going to have an impact, you know, eventually. So want to make sure that the users have all the most pertinent information to be able to assess how you're doing.
Yeah, because, you know, a lot of times the survey stuff particularly, it takes a while, like, and so there may be a fine associated, you know, and that might go on for months, but you don't really find out about a lot of that right up front. So those are things that you have to start talking about and trying to figure out so that you can plan for what that is going to look like and how do you record that potential liability.
And Allison, it strikes me that some of these disclosures, you know, may require, you know, that you be having conversations with your insurance broker, with your plan administrator, with your attorneys, with your, if you use an outside firm for compliance reviews or mock survey, you know, just you probably need to be having a comprehensive conversation with all your, you know, all your professionals, right?
Yeah, exactly. I mean, an audit is kind of all hands on deck, making sure everybody's on the same page about what's going on with your organization. So exactly.
Once again, all not bad business practices, but the audit may kind of push you to make sure that those things are getting done on a routine basis, right?
Which is kind of one of the points of an audit, right?
Yep. Sample audit timelines.
All right. Yeah. I just wanted to throw this out there. This is a very simple example of what an audit timeline could look like, just to give you a general idea of how things might flow. What isn't shown here is what should be going on now before the activities here really kick in. You need to be working on establishing your audit committee now, researching auditors that the audit committee is going to want to talk to and consider, documenting all your existing policies, procedures, controls. All of that should be going on as soon as humanly possible. So I did on the next slide, Andrew, give everyone a link regarding audit committee. We're part of the BDO Alliance Network, and BDO has on their website, and I've given you the link in that first bullet there, they have a pretty comprehensive audit committee guide that has a lot of helpful topics and an appendix with all kinds of good stuff like a sample committee charter and model meeting minutes and sample questions that the committee should ask, those kinds of things. So that I would strongly suggest that you check that out if you don't already have an audit committee rolling. So
no, some great links. And Allison, just going back to this slide, I'll just point out that, you know, if you have not been getting an external audit, you know, just look at this timeline and think about it. I mean, it's essentially a year-long, you know, process, right? For the audit. It's not something, you know, it's not like your tax return necessarily where you can just, you know, ship your shoebox off to the CPA at the end of the year, right? And they'll prepare your return. This requires a little bit of planning, and a little bit, your tax return requires a little bit of planning too. Your tax guys would tell you, but this, I mean, really, this is a comprehensive process that takes all year. And so, you know, if you're looking at this timeline and thinking about, there are things that in a perfect world should have already happened, right, for fiscal year 2023. And so if you're not getting an audit, you're already essentially behind the 8 ball. And while you have some time to get ready, that readiness has to start happening right now, right?
right. Exactly.
Excellent. Well, folks, I think that is it. We have resources and questions. We don't have any immediate questions, I think, in the chat room, but you're always welcome to email this team a question and we will be happy to respond in any way possible. But otherwise, we're a couple minutes early, but pretty much right on time. It's 12:52 by my clock. We appreciate everybody joining us for the webinar today. Hope you found it useful and informative. It will be online very shortly for future watching if you missed some of it, or if you'd have some other team members you'd like to have watch it. But thanks for joining us, and happy holidays, everybody. Thanks.